Hey, what's up everyone? This is the Smart Money Technician and welcome to today's video. This video that I'm going to be bringing out today, guys, is a absolutely stunning video because I wish that the things that I'm going to discuss in this video were shared to me at the start of my trading journey. It would have really fast-paced where it is that I would have been today, because the things that I'm going to discuss in this video, many mentors that are actually profitable, they do know these things, but they don't tell you off rip. They don't tell you right at the start of the trading so that you can fast-pace your trading journey. They drag the mentorship out so that you stay in the mentorship and they just waste your time. Well, I'm not here to waste your time. I'm here to tell you exactly what you need to be a profitable trader. High probability trading. We're going to combine ICT and quarterly theory, how to win most of your trades, putting everything together. All right, so the first important thing that you need to know is time. Time. We always hear a lot of people, they like to talk about time, but they never specific on how important time is. They always talk about time. When the time is right, that is when price will move. But they never elaborate on exactly what they mean by time, and they just waste your time. No pun intended there. All right, we're going to talk about time, and I'm going to be very specific on what time is. The key to understanding time is knowing the time that the market is likely to be high probability and the time it is likely to be low probability. We use the economic calendar to select the high probability days and avoid trading on the low probability days. So for indices, the highest probability time for day trading, keyword there guys, day trading, is during the New York session, preferably after 9:30, because after 9:30, most of the time the cracking correlation has already taken place. Whatever damage that they wanted to do has already taken place, and you can simply just use a nice fair value gap to trade in the direction after 9:30. That's why 9:30 is the highest probability time to trade. Low probability time, these are times that you are going to avoid trading the market because they are more likely going to cause you losses. Okay, so the day before NFP and the day after NFP, you're going to see that the day before NFP price is low probability, a lot of money is on the sidelines, therefore the market is not inclined to trend in a specific direction. And the day of NFP, you're going to notice that the precision element of price is not really going to be there. For instance, let's say you have a fair value gap, price is not going to nicely trade in that fair value gap, but it can overshoot the fair value gap, even though it still respects the direction that you're anticipating. So you should avoid this day, the day of a bank holiday and the day after a bank holiday. The day of a bank holiday, that day tends to be very short. Therefore, price does not have enough time to really trade in your direction for that day. And the day after a bank holiday, you're going to notice that if you go on the daily time frame, the day of the bank holiday and the day after a bank holiday are shared by one single candle. Therefore, time is really distorted and it is leading to low probability price action on that day as well, right? Now, also, you should avoid the morning session if FOMC is coming out in the afternoon session. The morning session tends to be low probability whenever FOMC, whether it is FOMC meeting minutes or the actual FOMC itself, the morning session tends to be low probability. Avoid day trading on a CPI day, not only because if CPI goes against you, you are going to be very painfully wrong, as it tends to not respect your stop loss. You're going to incur a very large slippage, but also at the same time, you cannot day trade CPI because most of the time the entry happens the previous day and then CPI just explodes. So you need to have been in ahead of CPI in order to really trade it, and that is not really day trading. So that is why I say avoid day trading CPI. All right, so the last thing is that during blank weeks and the week after a blank week, price may trade in your direction, in the direction of your draw on liquidity, but not give you SMT to confirm the move, and can disrespect SMT if you don't know what the draw on liquidity is. All right, so flexible draw on liquidity using the market maker sell model, also the market maker buy model, which we will get into as well, right? So the reason why I came up with this method is because in my studies, because I'm always studying and backtesting, I came to the realization that what I previously talked about, true week reversal, if you watched my video on daily bias, true week reversal is really what happens when the market is in its highest probability state. A state where once you've spotted the true week reversal, you can literally come in every single day and trade the exact same direction and be right and win your trades. This kind of market does not always happen. The market is not always that high probability. They're not going to try to make it that easy for you. Remember, folks, their job is to ensure that you are not profitable when you're trading this. Okay, so this method that I came up with really is going to fix that, and you're going to see why this is so wonderful in a moment. But this is the part where you really need to pay attention. All right, so we all know what the market maker model is. You can even go watch ICT's video on it. this over here, you know, this is the original consolidation where price consolidates or stays in a range, right? Then price expands, and price will either consolidate here or it will try to retrace back to the original consolidation. Then it expands, it hits a higher time frame objective that it was reaching into and no longer wants to trade any further. So it gives us a smart money reversal, which is the turning point, showing that the market has gone from being bullish to being bearish. And then we have price retrace, giving a low risk short. Price expands again, it gives a little consolidation or a retracement. This is called the redistribution. Price expands again, eventually reaching into the original consolidation, which is the draw on liquidity, right? So once you have a market maker model and you've spotted your market maker model, every single day, unless proven otherwise, you're going to be trading lower, right? Reaching ultimately to the original consolidation, which is your draw on liquidity. All right, so also with the smart money reversal, right, you are usually going to notice that there is an SMT taking place. Sometimes it is sequential, but most of the time it is an SMT with some random high, because the reason why they do it this way is that they don't want to make it obvious to you, but you will just see some random SMT there at the smart money reversal. At the same time, in between the smart money reversal and the original consolidation, we can have multiple accumulations. This one is the first phase accumulation, but after that another consolidation can take place, which can be seen as another accumulation, right? This that I'm just giving you over here is a textbook example. The same thing when we get the low risk short and then we get a redistribution, price expand, price might consolidate again, expand, consolidate, expand before eventually reaching the original consolidation. What I'm just giving you over here is simply a textbook example, but know that it doesn't have to look exactly like this. All right, and here we have a market maker buy model. We just flip it the other way, turn it upside down, and you have your market maker buy model. You have your original consolidation, your first phase accumulation of shorts, right? Your smart money reversal, your low risk buy, your redistribution, and eventually your original consolidation. And the whole point is once you spotted your smart money reversal, you want to trade here, you want to trade there, eventually reaching into the original consolidation, right? Now, in saying this, many people trade the market maker model with this, which is all right, but you are going to notice at times that price does not always reach into the original consolidation, and I'm going to teach you when that happens and how to flip your bias, which is very important, because once you've mastered this, your trading is going to become very powerful and you're going to know when to not marry a bias. All right, so now we have a market maker model, specifically a market maker buy model over here. You can see if you look on this chart here, there was an SMT with some random low. It's not sequential, right? And you can see that we consolidate. And notice that the consolidation does not have to look like some textbook consolidation. A consolidation is simply when you see price trading in between a specific price range, not clearly expanding. Like over here, it's expanding. Here, it's not really doing that. It is just going back and forth in a predefined range, right? So we have a consolidation, we have expansion, first phase accumulation, we have the redistribution here. Sometimes I just take all the consolidations and combine them into one because I'm not too concerned about this side. What I'm concerned about is this side. Once I've seen the smart money reversal and I know I'm bullish over here, where that smart money reversal, it really is confirmed when we see an SMT with it. So this is what happened on Friday. So on Monday, I would have been bullish, right? Because I can see a market maker buy model. But notice something. Price does not reach all the way to the original consolidation. And we're going to teach you when you can anticipate that and trade accordingly to know when to flip your bias, not expecting price to reach all the way to the original consolidation, which would have initially been your draw on liquidity. All right, so we're currently on the daily time frame. This is where higher time frame key levels are very important. You can see that this is the original consolidation on this lower time frame, right? So if you look over here, this is the original consolidation, but if we go to the daily time frame, you can see that over here, this is the original consolidation. And the reason why price did not get all the way to the original consolidation is because this was just a lower time frame, a higher time frame retracement, right? So price gets rejected inside of this higher time frame fair value gap, which does not allow price to eventually reach into this level. So price reacts off of this fair value gap, and then the next day we continue bearishly. But there are more things that we can use to really justify why this happened and anticipate this happening and trade according to this happening. All right, so we are introducing an if-then day. What's an if-then day? An if-then day is when price expands in the direction of your draw on liquidity. Over here, we were seeing a market maker buy model and we were initially bullish. Price then initially expands in our direction, but within that same trading day, price then reverses, trading into the 50% of the range between the low and the high of the current day. And when price does that, it does not go any higher and it does not go any lower, entering into the next trading day. When we enter into the next trading day, that day is considered an if-then day, meaning that we need more confirmation to have any bias. Our initial bullish bias is then suspended and we can either get a bullish move or a bearish move, which is why we call it an if then day, meaning that if this cracking correlation happens, then we do this. If that cracking correlation happens, then we do that. You understand? We don't have a specific direction, and we need to look for signs to pick a new direction or to stick with the same direction. Now, one thing that you also should pay attention whenever you have an if then day is that you need to look for signs that the market might either continue or the market might reverse. Over here, if we look very closely, we know that we have this higher time frame key level fair value gap that price reacts off of. Now, if we also look very, very closely, right, we can see that over here we have this down close candle. I'm just zooming in so that you can see that very clearly. And the candles that come after it are all up closed candles. So these candles are treated as one singular up closed candle, right? And when price reacts off that fair value gap and trades over here, it closes past the last up closed candles opening price. This is a true change in the state of delivery that takes place, right? So over here we have the price reacting off the fair value gap, trading to the 50% on an intraday basis, change in the state of delivery also taking place, right? But the real confirmation is going to happen on the actual if-then day. So to really confirm that price is truly changing its direction is when you are going to see a crack and correlation on this if-then day to truly confirm all of this. But you would be expecting it just by seeing these things already taking place, okay? And this ultimately leads to a CDOL, C-I-D-O-L, a change in draw on liquidity. This is something that I came up with. It is a tool that I use to help me know that the market is not going to continue in its direction, reaching to the original consolidation, but is actually reversing, change in draw on liquidity. Everyone has their own theory that they've came up with through their backtesting and studying of price. This is my own one, what I pioneered, the CDOL, change in draw on liquidity. And really, what truly confirmed it was this. So as price was reaching up into that level, you can see price consolidate, expand, a little bit of consolidation, reaching that level, reacting off that level. And if you look to the side right there, if you go to the price, there was some insignificant SMT that really took place, right? Which then led to this if-then day taking place. So coming into the if-then day, right? If you looked at GBP USD, right, you're going to see that there was an intermarket sequential SMT that take place. Now, I personally don't trade intermarket sequential SMT because it really is a SMT that only happens when the market is really not that high probability and you're not seeing cracks in correlation within the immediate triad that you are trading, but you're now having to use intermarket assets to confirm a direction. So we were bearish on the Forex while we were also bearish over here. That's why the intermarket sequential SMT worked in the first place. This is not an introduction to trade intermarket sequential SMT because there are things about intermarket sequential SMT that I've not truly shared. So I don't advise trading it. Simply stick to sequential SMT, but I'm just showing you what confirmed the if-then day. So on this if-then day, right, when we were trading in between the low and the high of the day coming into the next day, you get this. This is what confirmed it. And this is why price then sold off, and price did not continue bullishly like we saw over here when we were expecting price to get all the way to the original consolidation, and it reversed. Okay, so these are things that you need to pay attention to. When you know the drawn liquidity, you can trade in it, but when you spot an if-then day leading to a CDOL, you know that you can change your direction. All right, so now we're going to get through this very quickly because we're going to put everything together, and I'm going to show you how you could have implemented everything that I talked in this video currently in just last week's trading. Okay, so I took a completely separate price action, explained everything, and now I'm using current price action that recently happened so that it doesn't look like I'm cherry picking this or anything, right? All right, so right now we are on the economic calendar for last week, right? And you can see over here, Monday, there's no news, right? Now, can we trade Monday? Of course we can trade Monday. I don't know who came up with this thing that just because a day does not have news, it means that you cannot trade that day. You can't trade a day. Yes, it may not be the highest probability, but it is certainly a tradable day. Sometimes you might not get a grandiose move, but you can certainly catch a move 1:2, 1:3 on the lower time frames and be content with that. The next day we have 8:30 news. But why wouldn't we want to trade this day? Because it is the day before NFP. As you can see over here, NFP is on Wednesday. So this day is not going to be tradable. A lot of money is going to be on the sidelines. And we're also not going to trade NFP because of its low precision price action that it usually gives, right? And then Thursday would be a tradable day, but Friday will not be a tradable day, especially for day trading CPI, right? So let's look at what happened. So over here, coming in on Monday, this is Monday that we were going to trade, right? You can see that Monday we had a market maker model that formed consolidation, expansion, redistribution. Eventually we get the smart money reversal. And the reason why we knew it was a smart money reversal is that on Friday, these last up close candle, in fact, I forgot to really draw it here, but there was an SMT here as well. And we also gave a clean change in the state of delivery when price eventually closed above this series of down closed candles, right? So coming into Monday, we were expecting bullishness. And if you look very closely, there was a daily cycle sequential SMT that took place there. And if you waited for 9:30, you would have easily seen a clean fair value gap on the 5, the 4, the 3, the 2-minute time frame that you can use. Now, in future videos, I'm going to really go into deep detail because there is a hierarchy of entries that I use when day trading. It is a very, very precise way that I do it. And yeah, you're really going to benefit from that, but I don't want to get into that. That is going to make this video too long than what it already is. So daily cycle sequential SMT, lower time frames, you would have seen a fair value gap to get along with that. You would have easily catch your 1:3. Trust. Tuesday, right? What did I say we're not going to do on Tuesday? We're not going to trade because it's the day before NFP. Does this look like a tradable day? Now, there were some people that said Tuesday was going to be a tradable day. Does this look like a tradable day? Huh? Exactly. Price goes up and down, chops left. Bruh, like, we're not trading this, okay? So we are definitely avoiding Tuesday, right? Wednesday, NFP day. Now, what I did say about NFP is that the precision elements tend to not really work. We did get a bearish weekly cycle, sequential SMT, but price was like, it first went up, then it went down, and it was not too precise. And let's say you were using a fair value gap, price could have overshot your fair value gap. So NFP is really a 50-50. I personally don't trade on NFP, but I was most certainly interested in trading Thursday. And on Thursday, because let me go back, because of what took place on NFP, can you see price initially expanded, gave a sequential SMT, traded lower, taking out the low of the current day, but then also gave another retracement back into the current range. So what did I say an if then day constitutes? When you get an expansion. So if we just take from here where price expanded lower and then price on an intraday basis traded back to the 50% range and does not go any higher or lower, the next day is going to be an if then day, which is what happens on Wednesday. Now, because of what happened on Wednesday, this made Thursday an if-then day, meaning that the initial market maker model that we were expecting, price has taken a pause on that on Thursday, and we might not see price getting into the original consolidation. Now, what did I say about if-then day? There will sometimes be hints before price action takes place that can really tell us what is likely to happen. So over here, right, although there was not a high time frame fair value gap that caused price to trade lower, we did get a sequential SMT that takes place, and then we got an if then day. Now, one thing that I did say about an if then day is that it will really be confirmed on the actual if then day itself, meaning that on Thursday we are really going to get the exact confirmation that price is either going higher or lower, which is what we then call a DOL if it is going to change the direction, a change in draw on liquidity. So whenever you are getting your if then day, you take the high and the low of the previous day, right, which we are trading in between, and you want to see your crack in correlation that is bullish happen in the discount and your crack in correlation that is bearish happen in the premium. Now, if you look at this day, look over here, that is the low of London, right? Price did take out the low of London, but if you look where price was, we were in premium. So we cannot accept a bullish price action for an if then day happening in the premium of the range. We cannot expect a bullish crack in correlation to happen in the premium of the range, which is why it failed and price eventually went lower and failed the daily cycle sequential SMT. But a 90-minute cycle sequential SMT is what works. Why? Because price was in premium when it formed the 90-minute cycle sequential SMT, confirming a change in the draw on liquidity and price trading lower. And if you traded this day, which I did, right, price easily gave you a nice move. Like if you entered very early, you can simply use the 5, the 4, the 3, the 2-minute time frames, fair value gap, return back into the fair value gap, and you would have nicely caught that move down. And then as you can see on CPI, we were not going to trade CPI because CPI is not good for day trading, and there was not really even sequential SMT that really took place. So yeah, it was not that good of a day as well. So all in all, you can see that this is literally so easy to do. The time that you're supposed to trade is so straightforward. I literally gave you the rules for that. The only hard part really, I would think, is identifying the market maker model, and it's not even really that hard at all. It's actually really easy once you just put a little bit of practice in properly identifying the market maker model. Some of you simply think that because price does not reach all the way to the original consolidation, it must not have been a market maker model, and I have incorrectly identified. No, you simply did not identify the if then day leading to a DOL, a change in draw on liquidity, and that in itself is very straightforward as well. If then day, simply when you see price do an intraday reversal reaching into the 50% of the high and low of the current day that you're within, and you see price go into the next trading day and you're still within that range, the next day is an if then day. It's that simple. Okay, so by combining all these things, you are able to trade in line with the draw on liquidity and also be flexible by changing your draw on liquidity. Folks, no one is going to give it to you like this. You can go and backtest this. Since the start of the year, I believe you would have only incurred maybe 2 losses. I kid you not. I kid you not. If you select the day that you are supposed to trade, the high probability days, you are making your life so much easier Please like, comment, and subscribe, folks, because I don't believe anyone is giving this kind of information to you for free. Most people would charge you for this, and I don't blame them for, because this is very good information. And because it's being given to you for free, many people take it for granted. I do not have to come here every day and be dropping content for you. The information that I drop every single time is always very high quality information. And by combining all these things together, tell me and show me how your trading does not improve if you properly apply them. Make sure you guys like, comment, and subscribe. If you have any questions, leave them down in the comment section. I'll answer them when I can. Peace out. The Smart Money Technician out.